Thanks everybody for joining. I'll go ahead and start some introductions. And while we wait for a few more folks to trickle in here, but thank you for joining. My name is Mark Coupland. I'm one of the executives here at GDS Link, and we appreciate you guys taking your time. I think it's, as we all know, it's interesting, and what we've seen with many of the financial institutions that we're working with is a whole variety, not only of economic indicators and market color, but a variety of around how lenders are reacting, right? And with this perspective on kind of what the move forward strategy is around liquidity and the varying perspectives, you'll hear a lot of those today on that go forward strategy. We thought it would be a good opportunity to consolidate some of these views, give you some insight in terms of what we're seeing and where you'll see maybe the market move next. I think as we collaborate on some of these ideas, it's really helpful, and I think some of those that are being really strategic out there are going to stand to gain a lot as we move forward. So to provide a little bit of that color for you today, what's happened in the past, how the market's reacted, who's come through prior down markets ahead. We have two people that are going to bring knowledge and some different angles to the table. The first one is our own VP of Analytics here at GDS Link. His name's Carl Spilker. He's going to moderate for us today. His team here is building dozens of models right now and really helping organizations of all sizes and shapes, different verticals, leverage data better and optimize for risk. Because of the hundreds of lenders that GDS is helping globally, Carl's team has a lot of perspective because he is talking with many of them around the issues that they are addressing today as it pertains to liquidity, performance, etc. But Carl has also been in your shoes in the past. He served as a senior risk executive for numerous organizations like Easy Corp, Lloyd's TSB, Provident Financial Corp, G Credit Cards, Dollar Financial, etc. So that's Carl Spilker. And then we have Josh Tonderys, who's going to be fielding several questions for you. He's got a load of experience, including being the president of Marlette, chief operating officer of Prosper, and executive at Barclaycard, and now at Colchis Capital. He's interacting with a bunch of different organizations and is very keenly aware of what it means to provide capital to this industry right now. So as we move into this presentation, it's really more of a conversation today. Please, we want to make this as interactive as possible. I will be back in a few minutes to help facilitate some Q&A. So you should have some controls to be able to maximize your screen, but also ask questions through the chat. I'll pick up those questions along with our team here at GDS, and we'll try to get to as many of them as we can at the end of the call. Depending on the question, we may even unmute a couple of you. We'll see how it goes. But we're going to keep the conversation pretty fluid and simple, and really talk about how lenders are responding to today's market, and really focus on addressing your questions most of all. So with that, let me pass this off to Carl Spilker.
Hey, thank you, Mark, and thanks to Josh in advance for fielding a lot of my questions. We put together a couple pages here, more as a teaser deck, teaser bullets, I should say, to open up some conversations. Interestingly enough, when you try to hone in on a succinct issue that's happened around this COVID period and post-COVID, if you guys feel like I do, it's a very schizophrenic period of time. We had a tremendous amount of unemployment filings occur, and a mix of what I'll call people going on deferment and financial hardship programs. I think that here's some recent stats of about 15 million credit cards at the moment inside those programs. We had a weird mix of almost 3 months of a tax season where people got their taxes in early and received a lot of extra income from the government for this pandemic event. while we've got a bit of a delay in our taxes that will be coming due here in July. And for some of us, that's welcome to have a nice 3 or 4 month delay. There's the insight into the line reductions potential that be coming the way. What happens when liquidity is being pulled away from folks? And what I thought I would do is just kind of shift for a tiny second, because one of my key questions I've been wanting to throw towards Josh is specifically around this unemployment. Josh, what do you see lenders doing differently in today's market given this impact? And if so, is anything different than we've seen in some prior recessions?
Yeah, thanks, Carl. Good to be here with everybody today and share some of my experiences, both historically from previous economic downturns, and then here we are today again. Didn't think we would be here as quickly as this is all transitioned, but obviously there's a lot we can learn from looking back at what happened before in the great financial crisis and compare that to what's happening in the economy today. Thinking back, I was actually in the banking world during the great financial crisis, and I think broadly it's recognized that the system was basically insolvent. There was so much leverage in the system, and then when liquidity went away, banks needed to recapitalize. They needed support of the federal government to recapitalize. And so as unemployment was increasing, it was increasing at a much slower rate than what we've seen with really just a very abrupt change in the rate of employment. And so what you had at that point in time was banks that didn't have liquidity and really were not prepared for dealing with the mass amount of unemployment at that point in time. FinTech didn't really exist back then, and so as I recall, being at that point in the cycle in the great financial crisis, that it was the banks really needed to get repaid on their loan books, and in order to do that, they really had to ramp up human resources and collections to be able to do that. There wasn't as much of a technology solution, and there weren't as many, I think, accommodations being made to help bridge the gap between a temporary unemployment and meeting the obligations on the loan. That's changed a lot, I think, post then. We've seen the banking system being reformed, and with the passage of Dodd-Frank, and banks really much better prepared from a balance sheet perspective, being better capitalized, and I think proactively looking to help borrowers that are in distress. You had mentioned the 15 million card members that are, that have been enrolled in hardship programs or forbearance programs to help them through this time period. That really didn't happen in the prior crisis. I was actually looking at my Credit Karma app yesterday to see what was going on in terms of lenders who are advertising and who's still kind of out there making loans. And I was surprised to see that there's actually a lot of help on that type of app that the card issuers have put out there to help consumers navigate with their individual bank card providers a hardship, or with their auto lender a hardship. So there's been I think a very different push in terms of helping in a way that didn't happen in the prior recession. And I think that there's both the banks being in a better position to do that. There's the technology that's helping to enable that, and then I think just the general understanding that this pandemic situation isn't a situation where you had people who just overborrowed and weren't responsible, or whatever the case may have been. From previous recessions, this is a situation where, broadly speaking, consumers have been very responsible coming out of the last crisis and have delevered significantly. And all of a sudden, you have upwards of 40 million people that are unemployed. And there's, I think, a lot more empathy around this situation, which has affected so many people, everybody really. And now you have a lot of consumers that are signing up to enter into these deferment programs. What we've seen thus far, at least the data that I've been looking at, is that you're seeing consumers act very responsibly in this time period. The payment rates from different securitizations, where there's public data available as those payments are remitted from the trust, are coming in strong, and you're seeing consumers paying at rates that are pretty similar to the pre-COVID rates. And to Carl's good point, there are a lot of factors that are helping that. You have you have tax season, which coincided with this starting. You had the $1,200 stimulus check that many Americans received. You have really unprecedented financial support from an unemployment assistance perspective. So there is a lot of support from the government to help consumers through this crisis, as well as the financial institutions kind of leading in as well to, hopefully bridge what is a more temporary situation. But we'll see. I mean, it is early days, and I think that the next step along the way is seeing how consumers that have needed to utilize some of this financial assistance, how they're able to perform on making their repayments as those extensions roll off and they're resuming their normal payment schedule. We haven't really seen that so far yet, and I think that's something that a lot of lenders are going to be watching closely.
Thanks, Josh. Sticking with that vein of a bit of a paradox, there's a lot of capital locked up in these deferments and forbearance financial programs. But there's also been, like you said, a significant release of capital. You're correct. We're seeing a lot of activity, even in the subprime and mid-prime / non-prime space, of people paying down their loans fairly aggressively. We've got one of these buckets here that, the new loan growth, people taking out new loans, has dramatically dropped off. So where's that money going, or do you think it's just sitting on the sidelines?
Yeah, I mean, I think it definitely depends by asset class, by issuer type, and what type of collateral is available. So I know that you personally have a lot of experience, a lot of connectivity into the short-term lending space and payday space, and shared some interesting insights just a minute ago and with me previously about how these portfolios are really paying down quite quickly, both because some of the borrowers have a lot more capital available than they did prior to this with some of the government support, and also because the places in which they went to borrow historically were in the physical world instead of the online world, and in some states those physical locations are to borrow are not deemed essential businesses, and therefore these loan portfolios are liquidating because they're short duration and they need to originate assets to kind of keep the balances out. That's really not the case in some of the other segments that we that I have experience with and work with different platforms. In the marketplace lending arena, where I've spent a number of years, is pretty hard hit. I think it's pretty well known that some of the larger players there have had to pull back dramatically from an origination standpoint, and that's not because of the same reasons necessarily. Where there's still obviously an online platform is able to originate, and consumers being at home, you'd think that there'd be a match there, but the mismatch there is just the liquidity that was being provided to these platforms from different capital providers has dried up, and that's I think as a result of other asset class having higher or more secure relative value from versus buying a whole loan, being able to buy a senior secured bond in the ABS world, where you have a similar coupon because the credit spreads have widened out significantly as people in the investment space have needed to potentially sell their positions. And so secondary portfolio sales and senior securities were were a relative value better trade for people to invest in than new origination, and that just makes it hard to originate new loans until those spreads come in. And we've seen that start to happen. I think kind of the worst of that period was in the middle to end of March, where there was really attractive things to buy in the ABS world, and capital, I think, for the most part, was on the sidelines for buying new originations. But as those spreads have tightened up, I think that capital is starting to flow back into the marketplace, into the marketplace platforms, and they're really starting to kind of pick up dramatically more than they were in April and beginning of May. Banks, on the other hand, they obviously have the liquidity, but I think kind of the feedback that I've had is that a lot of them have pulled back because they weren't able to adjust their lending policies and didn't really kind of have either the tools or agility to be able to adjust policies that they felt would be appropriate given the environment. And so that while they have the liquidity and have the ability to originate, many of them have pulled back significantly from their activities just because of their ability to underwrite and to be able to change their credit box.
Thanks. I went ahead and moved to the next page about lenders responding. And I know we spent quite a bit of time on forbearance. I thought I would pause for just a second to see if Mark had a couple other observations, or we had a couple questions that were coming in from the audience. And then Josh, I was wanting to kind of pick on you about this topic of the natural disaster approach that was brought up. I found quite interesting. So let's see what Mark or Liz, if we've got some questions out there.
I've got one question so far, and please do feel free to contribute as we go. One of the questions here was to Josh. You had mentioned Credit Karma. With this liquidity crisis, what do sites like Credit Karma look like, and how should a lender be approaching them now? And maybe that's something that we answer now, or we can push that back to later on.
Yeah, I mean, I can try to adjust some of that. Maybe Carl has a point of view too. A couple of things that I've seen is that there's just a lot less activity on those sites, where especially in the personal loan space, a number of the marketplace lenders that have had significantly less funding have reprioritized their marketing budgets, and in reprioritizing their marketing budgets, it's more efficient for them to remarket to existing customers, because that can be done via email or kind of on a statement, whatever, basically free marketing channels with known customers that are just all things considered. You have more data to underwrite that consumer because you have their repayment and their bureau. It's a safer bet because you have a lot more information with which to make that decision. And so a lot of the marketplace lenders have shifted their budgets and are originating. Since their originations are down, they're prioritizing free originations before paid originations, and so there's less activity on those sites. I know that kind of across the board, interest rates have gone up for consumers because investors are demanding a higher return to purchase the loans than they were previously, and financing costs have gone up for the different lenders. But for people that are well capitalized and do have the ability and feel like they can originate in that channel, I was speaking to somebody who a lot of their funding is coming through credit unions and other sources, and is utilizing channels like Credit Karma. They previously weren't effectively able to compete in those types of channels because there was so much competition, and they didn't perhaps have all the tools that some of the more tech forward lenders had. They didn't feel comfortable operating in that channel, but now that other people have pulled back, there's actually a lot more volume, and they feel like the selection that they're getting from those channels is actually a better mix of borrowers, because there's a little bit less competition and you're less exposed to things like adverse selection if you're not if you don't have a really strong value proposition or a very efficient borrower funnel. So I think there are opportunities in those channels today.
Great, thanks. Go ahead, Carl. We'll pick up with some more questions shortly.
Perfect. And so one of the reasons we kind of picked on liquidity is we were highlighting, you need money to make money. So you got to have capital to lend, and with the market kind of playing a little bit of their head in the sand, a chunk of them are sitting on the cash at the moment. We've just recently started seeing indicators. I think you mentioned, Josh, even on Credit Karma, things are starting to gently pick back up. But one of the pieces I wanted to ask you about is the natural disaster approach, kind of the thinking there. And then I'd love to kind of weigh in on the revising the collection strategies and some of the challenges that are to come as these forbearance balloon starts coming through. But the natural disaster approach, you had an interesting perspective from there. Could you elaborate?
Yeah, I mean, I think that it's along the lines of what we were talking about before, where there's been a more coordinated effort to make programs available to consumers. And if kind of a lot of the people on the call I know are operating lending businesses or involved in lending businesses and have rolled out programs like this as hurricane season hits a different part of the Southeast every year, and it's a pretty common accommodation that lenders will make, where they will identify FEMA designated counties or zip codes where where the disaster has occurred, and they will roll out programs either proactively to re-age delinquent accounts or to pause interest and fees and things like that. And it's basically the
proactive nature you were describing earlier, where it's so much easier for people to sign up for these programs, right?
Yeah, and so now the programs have basically been enabled for consumers, and like I said, they're even partnering with affiliates to be able to push these programs out, and it's in the news media, et cetera, and so a lot of consumers are taking advantage, and I say that in a positive way. They're utilizing these programs, and so I know that there's been a lot of studies. We've looked at the portfolios that we've financed at my company, and how the loans that enter these programs from a natural disaster perspective ultimately perform after they roll off the program. And I think the stats are encouraging. So we'll see what happens in this case, where it's a lot more widespread versus a very targeted kind of FEMA oriented approach. But I think with the methodologies and the programs being available similar in nature, it's not too far of a leap to hope that we'll see some of those positive kind of return to normal perspective, and that when these programs are offered during natural disasters, you do see a pretty significant reduction in delinquency and roll forward of delinquency by offering people a better solution than just not paying. And so I think that there definitely will be lessons to be learned from this, and kind of in my background, I know you're going to talk about collections, but I've spent a lot of time in collections too. It always is a net positive by trying to find solutions to meet the customer halfway when they're or kind of on their terms as they're experiencing a financial hardship. It kind of taking a hardball approach to getting repaid, it just in my experience doesn't really work. And you need to kind of greet people with the flower and find a way to bring them in. And I think that it'll be interesting to see how this pans out. But I think it's a much better approach than the previous great financial crisis.
Yeah, in that vein, this payment protection program, I heard a quote from somebody suggesting that pretty much decimated the small business lending with that amount of capital going out to the marketplace. That's a perfect example of this kind of the natural disaster approach here. So to your point is coming out of that, our business is going to be in a better state, a worse state, or hopefully a good portion of them in a neutral state to get through this pandemic period.
Yeah.
So, so we're talking about liquidity, and collections is going to be a big piece of it. How do you think folks are going to approach handling, what was it, 40, when we did the presentation, 36 million unemployed, now it's 40 million. Coming through this forbearance balloon or towards the end of it, the ability to collect it and, like you said, adopt the results is going to be really critical, I think, on modifying your stance, giving people a better way to pay with their willingness and ability to pay, and certainly certifying that they're still either employed at a reduced pay or for a sizable chunk unemployed receiving better pay than they may have in the past, and then those that are going to be coming off of unemployment seeking new jobs. How do you think is that going to just put more capital into operational expenses, or do you think it'll truly just weave its way through and people make their willingness to pay at that same rate they've been doing in the past? Any thoughts on that before we jump to the next page?
Yeah, I mean, I think that there's sort of at least what we've seen so far is there's a decoupling of unemployment rate and increase in delinquency. So the same correlation of the two, which we've seen in previous recessions, it's like a 0.8, 0.7 correlation between the two. Whereas if your unemployment rate goes to 10, your loss rate might go to 8. This is sort of like in unsecured consumer land. It's broken down a little bit, and I think it's been broken down by all the support, and both from the lenders and the government. But to your point, eventually the forbearance programs will roll off. I mean, I think there will be extensions to some extent, but eventually they're going to roll off, and there will be a bubble of delinquency that needs to be worked through. I think that lenders that have invested in technology to create self-service channels, to really help to automate some of the loan restructuring, decisioning, and the communications being more digital than phone call. I mean, I think the lenders that have invested in those areas are better positioned to deal with a big onslaught of delinquency than those that haven't. And those that haven't are more in line with kind of how things played out in the previous recession, where it was just you had to add a lot of people to be able to have the conversations with consumers and figure out where they are. And the other issue with that is just the more people that you add, the more inconsistency you can get in the treatments, and really having kind of defined rule sets for how that are fair, that are compliant, it's super important always, but especially when we're dealing with this many cases.
Thank you very much. You actually answered one of my questions on the longer term implication to the customer. Thank you. The traditionally less qualified borrowers, do you think they're in a better situation during this period of time, or do you think I'll say the mid-prime, prime customers in a better situation?
Yeah, I mean, I think it's an interesting question, and one that we talk about. There's kind of pre-recession, I think, especially people that are in the near prime space will say things like, well, my consumer's always in a recession, so therefore there will be less volatility for the consumer in a period of stress. And every recession is different. I think in this case, there are early signs that could be true, because, or a reasonable argument to be made that could play out that way, just because there's so much support from the federal government to really backstop the consumer, and especially some of the lower income consumers, where either the government stimulus or the unemployment support is maybe exceeding their earnings capability prior to the COVID situation. But that, it's a temporary thing. So I think there's a lot of factors to consider in terms of what's that borrower's ability to get reemployed, and what's the stability of that person if they were trained in an industry that's going to have less jobs on a go-forward basis. We've seen certain industries hit a lot harder than others, whether those are hospitality and transportation. So I think there probably are some cases where that's true, but there's a lot more detail to probably think through in terms of where there could be better opportunities to lend. And I think just looking at some of the traditional bureau data in general to identify is this consumer going to be a good credit risk, you might find more inconsistencies coming out of this. So that there, as we've talked about, people being on forbearance programs, are those forbearance programs being reported to the bureau in a way that's easy to interpret, or are there misreportings that are happening on consumers bureaus that will artificially keep people's credit scores higher, and other cash flow based underwriting decisions become more important in this time period because you can't really lean on the same relationships or information value from some of the traditionally predictive attributes that are maybe a little dirty now.
Hey, I did get a question someone asked about on the collections, and it's any financial institution demanding the clients to pay interest on their loans during this period of time, even if they're not making a principal payment. What's your thoughts on that? And I'll kind of weigh in on my thoughts.
Yeah, I can't speak. I've looked at there definitely are some publicly available places where you can see what the forbearance programs. I know that there's a marketplace lending website called Lend Academy that a lot of people look at, and they did a pretty good job of outlining what the different marketplace lenders are doing. And I think there are some that are on interest only payments and no principal at this time period. There are some that are no payment at all required. I think there's a mix of different programs that are being put out there for borrowers.
Yeah, to me, just keeping constant contact is absolutely critical. So there is something that does make sense, even on the smallest amount. You're just staying engaged with the customer and kind of working through some of their problems, which is maybe what that at least paying the interest is allowing folks to do. I'm going to go ahead and move to the next page, Mark, and Josh.
Sounds great.
And kind of jump about into the takeaways. So, one of the key things we've mentioned, I think, throughout the conversation is, accelerating that cash flow. And that has to deal with a lot of what we talked about, the collections. It's a decent amount of what we talked about as far as getting people through that deferment forbearance in a better place so they can start paying back their obligations. And then 3 is, I think we've all realized digital experience is it's a new way of life now. And I'm very curious if people have taken a step back and said their business was in a great place because they had the right digital experience for the customers to either be self-engaged or engage online. What are your thoughts on those first 2, Josh?
Yeah, I think that's the place where the fintech lenders have done a really good job in terms of automating a lot of the decisioning in front end, but there's still a lot of work to do on the digital experience all the way through. And I think that the situation that we're in today, the different boxes that were on the previous slide around the forbearance bubble and head in the sand and all this, there's a lot more work to be done on the digital experience to really help consumers through through a difficult time, and to be able to make all the different servicing aspects of repaying the loan very easy for the consumer to see what options are available, to engage with the consumer in a manner that that works for them versus works for you. That depending on the originator, there's varying degrees of competency there. But I think to your point, everybody is looking to get better there. And this experience sort of, as everybody has moved online for everything at this point in time, really just highlights why investment in that area is even more important. It was important before, but it's even more important now. And so, yeah, I would expect that there's a lot more investment dollars available for these platforms to think about, for all originators to think about ways in which they can improve their digital experience and decisioning.
Yeah, I've received some feedback. That digital experience comes with a double-edged sword. My mother pings me with a CD that was going to pay 3-point-something%. And she sent me the website, and it was a reputable bank at a .net. Clearly, we called the bank, it was a fraud. So fraud's going to be a big issue, and being able to deal with that's going to be important as people get comfortable with that digital experience. How does one stress test their models? I mean, this is kind of a unique scenario, but I think my 10 cents is it's super important to at least evaluate your existing models, do your own stress testing, get a sense of how much your portfolio is going to take out of it. How much weight do you put into doing that type of exercise during and post this environment?
Yeah, I mean, I think I know for a bank, it's a requirement, right, that you're stress testing all these things. I think everybody keeps using this word unprecedented in all times at the kind of during this environment. It's hard to see how one would have thought about this as a scenario that you needed to stress test for, but here we are. And I think on the model side, it's really making sure that your models are keeping up with the current environment. So, some of the relationships that previously existed, do those still exist? Or are the populations that you're underwriting today still the same populations that you used to underwrite? So, as dramatic changes that we were talking about in terms of marketing channels where lenders are potentially cutting out channels completely, the mix that your models are dealing with today could be quite different, and having the right tools in place to make sure that you understand how the models are performing when you're making a lot of changes is important. It's easy to get kind of lost as to where you are if you're not organized and don't have discipline around this.
Yeah, I've heard a fair amount talking about their through the door mix is not the old through the door mix. So the old through the door mix is kind of driving the way their models are performing. But interestingly, they're getting a very aggressively different profile coming through the door. Yeah. I was able to participate in our Marketplace Lending Association webinar, and we talked about some new sources of data. Everybody's always scouring for something out there. Feels like this is a good time to tap into real-time bank transaction solutions, either via a credentialed path or non-credentialed path. How important is introducing new data? Is it too soon to do that from your perspective?
Yeah, I think it's always important to be testing new data sources. I think, the question right now is what are the outcomes going to be, and those are unknown. So it's sort of hard to validate in the new environment, new data sources, but I think it's always important to be evaluating different information sets and kind of comparing that against previous results to see how you can improve your decisioning quality. We talked about before that some of the data quality or bureau attributes may not be as predictive, remains to be seen. So I think it's ever more important to be able to understand what that consumer's stability of earnings power is and cash flow, and being able to look at the bank transactions to verify that the consumer is still employed, and getting signals from NSFs and other activities from their bank account is it's a leading indicator to what is not yet on the credit bureau. So I think there are advantages to being nimble and starting to implement that type of data into your decisioning, as a way to kind of combat some of the deficiencies with the data sources as a result of how issuers are reporting right now.
May very well be the new. I leaned on what I call the very last bullet here, which is probably a little more of my shortcoming. I love to think in a strategic box in many cases, but it really takes those people that can execute, so those experienced operators. So just kind of my 10 cents as we kind of wait things out, and now capital starting to re-enter the market. I like to give a call out to those guys that get things done, the experienced operators out in the industry. How important do you think it is for people to weigh back into the market fairly aggressively, or keep taking a toe step at a time, or dipping their fingers into the water? What's your thinking on that front?
I mean, it definitely helps to have people involved in the organization that have gone through this type of experience before. Every time is different, and I think having people that have seen more business cycles is value add, especially if this is the first recession your organization has been through, which is probably true for people who are on the call today, and a lot of fintechs where it's a newer business model, or not really sure how this is all going to work. Having people that have been through this type of different, but this type of environment before is super important, and really kind of, I think, in terms of getting back in the market, really having a disciplined approach to defining what are the metrics that are going to get you comfortable with investing more in new originations, whether that's early delinquency rates or acceptance rates or cost to acquire. Really just making sure that you think that the KPIs and metrics that you previously looked at are the right ones for today to get an early read on things, because it's unclear to me what how this is all going to work out, and really being disciplined about making sure you're measuring things and having a roadmap of when you'll move if data exists, I think is important to get everybody in the organization behind the same set of kind of criteria.
Agreed, completely. Hey, Mark, shall we leave open a few minutes so we can get some questions through the cycle?
Yeah, we'll ask a couple of questions, and then feel free also, the chat is still open if you guys have any. One I have here was, you mentioned fraud. What data sources do you consider? And I know, Carl, you since then had talked a little bit about bank transaction data, but maybe you both can explore that a little bit.
Yeah, this is Carl. I'm a fan of using as many different sources as you need to adapt it to your channel. So if people are mainly in a mobile-driven digital environment versus a internet-driven laptop type of environment, you would probably lean on a couple different devices. One thing that we've had the fortune of being able to do at GDS is we can bring in as many different solutions, and we prefer over a couple cycles to let those with the winning outcome become your winning provider. Retail's totally different than a digital, or even a digital laptop. Hard-coded internet station is different than a mobile iPad environment. So being able to test and bring those in is super important.
So the next question I have here is, you mentioned short-term loans and how they have liquidity. Does that mean that I should be focused on shorter duration loans?
Yeah, I thought it was it's a bit of a paradox, because every tax year about that time there's talk of the short-term industry of a substantial payoff, and we've in effect had 3 or 4 months of almost a tax period with the money coming through the system, and a fairly aggressive time frame where people have been paying down, buying product. So the question is, who's the one most likely impacted by this unemployment? It may be this short-term borrower, for example. So being able to ease into that market and know that they are either employed or they've got consistent revenue is going to be tremendously important. Josh, you touched on that with the bank transaction, would be a good way to see that. And I think they're just one of the early indicators where they're the kind of the canary in the cave. They're the first to see it, so you get to respond quickly as those short-term lenders, but they're also one of the very first to be able to respond back into the market, contingent to people kind of coming off their unemployment and moving into an employed ranks again.
I think in the installment lending world, it's it's a really good risk management lever where the shorter duration, the faster the amortization of the loan, the less capital you have outstanding, you're de-risking the future, and you're also returning capital quicker, either to your own balance sheet or to make new loans, or to your investors, hopefully for them to reinvest. So I definitely think duration's an important tool to be considering, and I think you'll see, at least in the marketplace land, where there were people pushing loan terms out on personal loans to 7 years, or an auto where they were going to 10-year, that those terms are definitely coming in, and for good reason.
Great. And then along those lines, related question is, do you have a perspective on installment versus line of credit receiving different liquidity treatment?
I mean, I think this kind of like payment preference question is one that you often get different points in the cycle, like which payment is going to be the preferred payment. In the last cycle, people prioritized their house lower than other payments because their house was underwater, and I think auto was the big winner in terms of the asset class that performed the best coming out of the great financial crisis. And I think in this one, and as the marketplace lending installment category has grown significantly, there's been a lot of questions like, well, what would you pay first? Would you pay if you were in a stressed situation, if you still had an open revolving credit line, wouldn't you pay that first before you paid your installment loan? And I think that there are reasons to think, yes, that could be the case. But there are also, some features in the installment loan that may make it a better performing asset class, all things considered, for the same type of borrower. One, for instance, is the amortizing nature of the product versus a credit card, which is not really amortizing. I mean, you can amortize, but the minimum payment doesn't really amortize the loan. So I'm interested to see how this works out. And but yeah, I mean, I think clearly the utility of a credit card is a motivator for people to continue to use that. But as Carl mentioned at the onset of the call, you're also seeing issuers who are removing utility and line from borrowers. So that I think it can go either way.
Right. Another question I had real quick is, I feel like my model is already stress tested in real life. What do you see as the performance impact that could happen going forward? You guys want to interpret that one?
Yeah, my thinking is how quickly you can adapt and adjust your model. The one common theme is the through the door dynamics of who they were used to seeing has changed fairly consistently amongst everyone I've spoken to, ignoring your consistent, repeat, loyal customers. So given that, I would actually, the model is going to rank, order, and predict, but it may not tune quite as well if the through the door population shifts. So just be in a position to retune and redeploy with a bit more frequency than maybe you've been able to do over the last 2 years, because things haven't adjusted or shifted that much.
Great. And then I've got another one. What approach are the large fintechs taking what can I do to stay on par with the industry at this point? And then what are they missing that creates an opportunity for us to move ahead? Any perspective there?
Yeah, I wish I knew the us. I kind of weigh the things with fintechs that they've been defined is they found a way to get access to capital, but they found a way to engage the clients seamlessly, easily, and digitally. For some of those that were behind the streams, generally speaking, they've got a decent amount of access to capital. This may be the way for them to accelerate that digital environment and get the tools to compete similar to these fintechs. Be a bit more aggressive, be a bit more selective, but get into the market very aggressively, because I personally think things will adjust to a reasonable norm and get back to a good growth state.
Great. And then last question, I'm going to combine two questions here to one that kind of talk about collections, right? One is around, are we, what's the sense around whether we're getting increased collection activity? Is it more or less than we have expected? And then kind of tied to that, during this period, is it responsible to ask clients to pay interest on their loans? And what's the impact ultimately on performance?
The first scenario, I think things have been quite positive for the collections. They're coming in better than they'd anticipated. I think there will be a dip when things are very difficult, if the market, the unemployment rate does not come back, and if jobs are not back to the market like they were 6 months ago. I think there will be a pretty aggressive collections bubble. The critical thing for collectors is to have engaged customers. And so if paying just interest allows that engagement, so they're still there, they're still interested, that's probably one of the most significant indicators of a good opportunity to collect on those accounts. And then 3, I think people need to be treating the collections infrastructure similar to a fraud model. There's got to be constant retuning, redeveloping, and leveraging some new techniques that are out there, such as machine learning like modeling, to optimize the results and to adapt to that shifting market space so they can stay operationally efficient.
Great. So here's what I would say, and I'll let Josh and Carl give some parting thoughts in a moment, but you can see on your screen that we have contact information for both of them. That's their direct email addresses. So if you'd like to reach out to either of them, they're happy to chat with you more, provide some insight. Obviously we wanted to share some industry color with you today, but GDS has some solutions, I think, related to some of what we talked about that Carl can shed some additional light on. So of course, I would be negligent if I didn't make a little bit of a plug there at the very end. But we do appreciate you all coming in and helping ask some of these questions and have us learn a little bit more about this time. And Josh, Carl, any parting thoughts?
Yeah, I mean, I think it's really important for folks, especially these kind of time periods, to look external and attending events like this or networking type activities and just trying to network and compare notes with people who are in a similar seat as you may be can be really invaluable, just because you want to know is what am I seeing, is that normal, or are people trying different things and having success or not having success. I definitely think it's events like this and having conversations like this that make everybody better. So I just encourage people to the extent that they can to keep the dialogues going and share information that can be beneficial to everyone.
I echo the same, Josh, and thank you for those that presented questions, and really enjoyed this and appreciate and hope that we get to continue the dialogue moving forward.
So thank you once again, everyone. I know that we're at the top of the hour, so we appreciate your valuable time.